Good morning, traders. This is Kevin Craney with RJO Futures coming to you from Chicago, giving you an update on interest rates this morning. We look at in the interest rate world here this morning. We see that U.S. Treasury yields as well as German bond yields, what's considered the safe haven, actually ticking a little bit higher here on the morning as we see some more of the risky assets such as equities and commodities trading a little bit higher on the morning. We did have a Fed official out overnight talking about a possibility of some additional stimulus coming in. Really, when we step back and look at the interest rate market right now, we have to look at what's going on over in Europe, of course. I think probably the big thing waking up this morning and seeing Spanish 10-year bonds trading at 660 basis points. That's at the high of the year. But certainly looking at Italian 10-year treasuries trading well above the 600 basis point level. That 600 basis point level has really been a benchmark here for the European peripheral. If you look at Greece, they could not hold their funding levels above that 600 basis point level. So how long are Spain and Italy going to be able to do so? That's the question that everybody's asking right now, and I think that's certainly what the U.S. Treasury market as well as the German Treasury market is looking at as well. The other thing that we have to consider is certainly the $100 billion bailout that we saw for Spain over the weekend. Excuse me, it was 100 billion euro. That bailout, it was a very short-lived relief rally yesterday, about 4.5 hours before we saw really all risk assets start to sell off and really see those the Spanish yields start to tick higher once again. When you dig into the meat of the details, you see that this 100 billion euros that they could draw down, it goes directly to the state, it goes directly to Spain, none of it goes directly to the banks. So the question is, how would the money be used? Would it be used to write down some of the bad mortgages that are on the bank balance sheets in order to start recapitalizing these banks, or would the money continue to sit on the state balance sheet? And I think that's what a lot of bond traders are certainly looking at, because then the question becomes, are senior bondholders going to be subordinated if the money comes from the ESM, or if the money comes from the EFSF, is Spain going to have to pledge collateral to Finland in order to obtain the money? So there are a lot of unanswered questions in this, and if senior bondholders are going to get subordinated, then the question then becomes, do people stay out of the Spanish bond market, which in turn will drive yields higher anyway, and the banks are going to have to step in order to help fund the country, and then you create an inverse loop because you have bad paper sitting on the banks once again, which would require them to go back to the EU for an even bigger bailout. So really the scenario that I'm explaining is it's a band-aid for the moment, and the structural issues remain in Europe, and you're going to continue to see a flight to quality, which in turn means a flight to the U.S. Treasuries and a flight to the German bond. I think there's more opportunity right now on the longer end of the U.S. Treasury curve, the 30-year Treasury bond. Right now we see those yields at about 273 basis points. You could easily see those tick back into around 250 to 225 here in the near term, particularly as we continue to see the meat of these details, and most importantly, we have the Greek elections coming up over the weekend, and that's going to weigh on the market pretty heavy. Please give me a call at my number, 888-596-5817, and we can discuss this and other interest rate details as well. I do follow other markets that we can discuss as well. And remember, futures trading is not suitable for everyone. It does carry a high degree of risk.
My name's Nick.